A narrative exploration for the intelligent investor. The extraordinary rise of artificial intelligence has generated excitement not seen in financial markets since the late 1990s. Companies connected to AI, sometimes only tangentially, have seen their valuations soar. A handful of technology giants, along with a growing constellation of AI startups, have become the gravitational center of the investment universe. A remarkable truth fuels the enthusiasm: AI is real, it works, and it is reshaping industries at a stunning pace. Yet intertwined with this reality is an unmistakable mania, an environment where fear of missing out overrides any sober assessment of risk. This blend of innovation, speculation, and investor psychology has produced something very familiar: a classic market bubble. Every bubble resolves. The only uncertainty is the manner in which it does so. For investors today, the central task is not predicting with certainty but preparing for the range of possibilities ahead. Three distinct scenarios stand out, each plausible, each shaped by economic forces, technological progress, and collective market behavior. Scenario 1, the bubble and bust. A Darwinian reckoning. The first and most historically common scenario is the dramatic, violent correction. In this version of the near future, the AI boom hits a wall. The trigger could be an economic recession that forces corporations to cut their technology budgets. It could be a series of high-profile AI startups that fail to deliver on their breakthrough promises. Regulators might intervene, tightening rules on data usage or compute access. Or perhaps the enthusiasm runs out, as speculative bubbles often do, when the next buyer suddenly becomes hard to find. When the unraveling begins, it starts at the edges. Small AI firms with little revenue and no path to profitability suddenly discover that investors no longer want to fund the moonshot visions. Companies that soared during the AI boom, firms like C3AI, or other richly valued newcomers, feel the pressure first. Their stock prices fall sharply as venture capital evaporates and the promise of future dominance looks less certain. The panic spreads. Even the mighty suffer. Nvidia, Meta, Microsoft, and other megacaps with legitimate AI businesses face multiple compression as investors question whether their extraordinary growth rates can continue. The mood shifts rapidly. Media narratives, once celebratory, turn cynical. Analysts talk of overbuilding, unrealistic forecasts, and delusional optimism. The panic feeds on itself, accelerating the decline. But while this moment is painful, it is also cleansing. Weak business models disappear. Speculative capital exits. Companies with real technology and solid financial foundations, firms like Microsoft, Amazon Web Services, Oracle, or Google, emerge stronger. They purchase distressed startups for pennies, absorb world-class talent, and consolidate their dominance for the next decade. This environment is harsh, but it ultimately rewards durability, cash flow, and competitive moats. Scenario 2, the soft landing, a graceful descent to reality. The second scenario is more hopeful, a long, steady normalization instead of a sudden collapse. In this softer landing, the AI boom cools, but it does not burst. Valuation multiples begin to shrink gradually rather than violently. Investors slowly adjust their expectations as the market transitions from speculative enthusiasm to fundamentals-driven analysis. This gentler correction depends on one thing above all: AI proving its real-world value at scale. Companies must move beyond pilot projects or marketing experiments and into genuinely productive use cases that improve efficiency, increase revenue, or reduce costs. When businesses see measurable returns, such as faster software development using Microsoft Copilot, or improved fraud detection in financial firms using AI analytics, they begin to invest more deeply. In this environment, speculative AI stocks may stagnate or decline modestly, but the strongest firms continue to grow. Companies like Adobe, Intuit, ServiceNow, and Salesforce integrate AI deeply into their core offerings, strengthening customer loyalty and increasing average revenue per user. Cloud giants such as Amazon, Google, and Microsoft benefit from rising demand for compute. Infrastructure players like ASML, Oracle, and Accenture see steady, sustainable growth. Instead of a crash, the market undergoes a smooth, orderly rotation from hype to earnings. For long-term investors, this is the healthiest outcome: boring, predictable, and grounded in real business performance. Scenario 3: the infrastructure supercycle renaissance. The building boom of the century. The third scenario reinterprets everything we are witnessing. In this version of the future, the frenzy around AI is not a bubble at all, but the chaotic early stage of a profound transformation, one that resembles the construction of railroads in the 1800s, the electrification of cities in the 1900s, the rollout of the Internet in the 1990s, and the rise of cloud computing over the past 2 decades. It is an era defined not by speculation, but by massive, long-duration investment that reshapes the industrial and digital landscape. AI is uniquely demanding. It requires unprecedented levels of computation, energy, bandwidth, and storage. The world must rebuild enormous portions of its infrastructure to support it. Semiconductor leaders like Nvidia, AMD, TSMC, and ASML benefit directly from an insatiable appetite for compute. But the supercycle extends far beyond chips. Power producers, from nuclear operators like Constellation Energy to renewables-driven firms like NextEra Energy, find themselves at the center of a new energy arms race. Utilities and grid modernization companies, including Eaton, Schneider Electric, and ABB, see decades of reinvestment ahead. Networking and data center firms experience a similar uplift. Arista becomes essential in high-performance switching. Equinix and Digital Realty expand their global data center footprints. Tower operators such as American Tower and Crown Castle modernize communication networks, supporting the rise of low-latency AI. And then there are the quieter beneficiaries, the software and cybersecurity firms that form the connective tissue of the AI ecosystem. Palo Alto Networks safeguards AI-driven enterprises. ServiceNow orchestrates the workflows that AI accelerates. Adobe and Intuit embed intelligence into creative and financial tasks. These companies grow not because they are speculative, but because they provide critical, revenue-generating tools that organizations cannot operate without. In this supercycle, volatility still exists, but the broader trend is upward and long-lived. Winners are determined not by quarterly earnings surprises but by their ability to scale, innovate, secure their supply chains, and maintain financial discipline over decades. Preparing for AI possible futures, the investor's compassed with 3 dramatically different futures ahead: crash, soft landing, or supercycle renaissance. The wise investor focuses not on prediction but on preparation. The first step is self-awareness. Many investors do not realize that owning a simple S&P 500 index fund already makes them heavily exposed to AI megacaps. These index heavyweights, Microsoft, Apple, Nvidia, Amazon, Meta, Alphabet, and Tesla, represent an enormous portion of market-weighted portfolios. What may feel diversified is often a concentrated bet on technology's continued dominance. The next challenge is avoiding financial dynamite. Leverage and speculative options, which magnify both gains and losses, are especially dangerous in a bubble. A sudden drop can trigger margin calls or wipe out options positions entirely. Surviving volatility is far more important than attempting to time peaks. True diversification, therefore, becomes essential. The AI boom is deeply intertwined with technology, so investors should look towards sectors that move differently. Healthcare, consumer staples, industrials, and utilities provide stability when technology falters. Energy, particularly nuclear and renewables, offers exposure to one of AI's most powerful long-term drivers, the need for cheap, abundant electricity. Even materials and mining companies, such as Freeport-McMoRan for copper or Albemarle for lithium, benefit indirectly from the rising demand for infrastructure and electrification. But above all, fundamentals must remain the North Star. Cash flow, margins, competitive moats, pricing power, and balance sheet strength ultimately determine who thrives and who fails. Investors should ask hard questions. Does the company generate cash, or is it burning capital? Are its margins improving, stable, or eroding? Does it possess data, technology, or distribution advantages that competitors cannot replicate? And for infrastructure firms, are their unit economics sustainable, especially considering the rising cost of power? Finally, there is one rule that towers above all others: never invest in something you do not understand. If you cannot articulate how a company makes money, why customers stay, and what protects it from competition, you are not investing, you are gambling. AI is already complex enough. Surviving the AI era requires humility, clarity, and a commitment to understanding the businesses behind the buzz. Thank you for watching the video.